Well, welcome back. Futures are rallying this morning on this, the final trading day of November. Check it out. Dow Industrials now at the highs of the morning of 218 this morning. 2/3% on the Dow. The Nasdaq up 53. That's 1/3%. And the S&P 500 higher by 1/3% at 15 points higher right now. The month of November has been a good one for the stock market. The Dow Industrials up 6.5% this month. The Nasdaq up better than 9%, and the S&P 500 higher by better than 7%. We are awaiting the October PCE index that's coming out in about 4 minutes. Economists are expecting core prices to be up 0.2% month over month and 3.5% year over year. Joining me right now is the former president and CEO of the Kansas City Federal Reserve, former FDIC vice chairman, and the distinguished senior fellow at the Mercatus Center, Thomas Hoenig, back with us. Thomas, great to see you this morning. Thanks very much for being here. How would you assess inflation today, and what are you expecting this morning from today's report?
I expect pretty much a continued decline in inflation as reported by the PCE. That's in line with what the CPI came out earlier this month. So I would expect that pretty confidently as we go forward, and then we'll see what happens in the future. So right now, go ahead.
No, please go ahead.
I was saying right now, things are at a point where you get all this excitement about the fact that now we're going to have a soft landing and the Fed's going to cut rates. And I think that may be a little bit optimistic. Yeah,
and that's been basically the consensus for so long in markets, leading this market up 36% year to date on the Nasdaq, up 7% year to date on the Dow, and up 18% on the S&P 500. Thomas, what about the components of inflation that we look at so much? The sticky ones like rent, still elevated, many food items still very elevated. The price of oil, of course, is off of the highs of the year, but still talking about 70 plus on crude. Why are we seeing such elevated inflation despite these 11 rate hikes from the Fed?
Well, I think partly because there has been an enormous amount of government reaching into the economy, supporting it. Number one, as I've said, investment would be down more than it is today, except you have the CHIPS Act, you have the Infrastructure Act, you have the so-called Inflation Reduction Act, which has poured money into the system. That's helped elevate the economy, I think, to an important degree. And I think those are the sorts of things that we're forgetting. Also, there's still a fair amount of liquidity in the market that's able to fund some of this debt. The money markets still have a lot of cash that they're using, even though it's less than it was, as they have funded past government debt. But that's slowly being brought down. The excess savings that was behind the consumer, which was enormous, over $2 trillion, that's finally now just about spent. So those are the sorts of things that have been, I think, putting increases in demand into the economy, which has allowed the GDP to be so strong. And that should be fading away, and that leads to thinking about the future a little more seriously, I think.
Yeah, I mean, we've been scrutinizing the GDP numbers because I think underlying the headline number, there are real questions about business spending, about inventories, another issue. Are you surprised that we haven't seen more of a slowdown given the 11 rate hikes?
Yes, I guess I am. I thought there would be a greater slowdown. I think people have miscalculated, including myself, just how much stimulus was being brought into the economy. And as that begins to diminish, and it is diminishing, I think going forward, the banking industry is still under a lot of pressure. Its unrealized losses are on the books, not only in government securities, but on their loan portfolio. They're tightening down credit, so that's part of the future.
Yeah.
Private investment has been under pressure as well with higher interest rates. That's going to continue to have an effect. And the liquidity that was in there is slowly bleeding out. And that's why I see the consensus says a 15% probability of a recession. I think it's higher than that. Although I hope I'm wrong, I still worry that the economy is going to be in for still some tough times ahead.
Yeah, I mean, I'm questioning the Atlanta Federal Reserve's numbers, frankly. The numbers are imminent on PCE. We're waiting on the October core PCE prices, as well as jobless claims and personal income. The market is rallying right now. Cheryl is working on this. Up 236 on the Dow Industrials going into this. Cheryl, what can you tell us?
Well, I've got some of it. So let me go through what I do have. So I've got spending and consumption right now. That came actually in line with a gain of 0.9%. 0.2%. And then for income for the month of October, that also coming in line, up 0.2%. We also had claims just cross, and I'm just getting the other numbers now. It looks like claims coming in at 218,000. The estimate was for 220,000, and then continuing claims 1.927 million. Estimate was 1.872 million. So that's kind of the story there. All right, let me look at PCE. So we're coming in flat on a month-to-month basis for the headline number. This is the month-to-month basis. That's actually less than expected. We were looking for a gain of 0.1%. That came in. We came in line with the headline number year to year. That is 3%. So that's actually the headline number. And really quick, that's the Fed's 2% target. That's that number. So it's at 3%, not 2%. Everybody, it's at 3%. Core in line. Coming in line on both reads, both the month over month and the year over year. 0.2% to the upside for core. Of course, that excludes food and energy, but come on, folks. That's all that everybody's talking about. And then it came in at 3.5% year over year. So those numbers on the core level for PCE coming in line. And so that year over year core, that 3.5% in line, that's the Fed's preferred target, but really that inflation target at 2% that they've got, that's still at 3%. So we're not there yet. I've said this before, I'll say it again. You just have to wonder sometimes if they're going to have to reassess what their inflation target is. But that's just my humble opinion, Maria. I'll send it back to you.
Cheryl, I know you're still digging through more of this report, so we'll get back to you as you continue to analyze what we're seeing here. Market is pretty much steady, up 208 points. The PCE index basically looking like a flat situation. Thomas Hoenig, what would you expect for the first half of the year next year with regard to the Fed and how they're going to backpedal out of this, these 11 rate hikes? I mean, is it even feasible that the Fed, after raising rates for 11 times, Thomas, that we would see them cut rates in the first half of the year next year?
I think the possibilities of cutting rates are, take two lines. One is that they somehow magically meet get closer to 2%, down to 2.5%. The economy is still going, but slowly, and they decide to cut because they are close to the 2% and they want to avoid a recession. The other is that they keep rates higher until they get down below 2, or down below 2.5, and the economy does slow more dramatically. And under those circumstances, they will cut again at that, or they will cut at that point. So I think the latter is the more likely, because I think the economy will slow more quickly than people anticipate. And that means they will lower rates depending on how that goes. And that could happen, I don't think in the first quarter, but in the first half of the year, I think that is a possibility, that the economy slowed more than they anticipate and that they cut rates to try and offset the what I'll call the pending recession that might in fact come in the second quarter of the year.
All right, 3% higher on core PCE price index, up 0.2 in line on the core PCE headline number for the month of October.